Hello guys, welcome back to YouTube channel of Castaway Trader. Today we will talk about trading options and I will share with you one of my dirty tricks of trading options, and I hope that that trick would change the way how you play options, and I hope it will change the way how you trade not only options but maybe ETFs and futures forever. Let's see. Let's get started. So let just me remind you about my website www.castawaytrader.com, where I regularly update my counts for silver, gold, crude oil, natural gas, and major US indices like Nasdaq and Russell. You can also follow me on Twitter. My name is Castaway Trader on Twitter and on Stock Tweets as well. So please read that important information before we start. Okay, we will talk about trading options based on one example, specifically the count I posted on my website on Thursday, April 5th, around 10:30 a.m. So we've got that rally of the low made on April 3rd or 2nd, and that rally was unexpected by me. And so basically I missed that part of the rally and I was eager to catch the top of that rally to short it. And once I spotted my favorite topping pattern where we have only one micro squiggle left, I posted that count. The pattern is that we've got micro 3 up, 4 down, and from that I expected the final ABC up, and once we made A and we were ready just to bottom in B, I posted that on a micro level we need one more rally to a new high to complete the wave 3 up and start a pullback in wave 4, and I even suggested a potential path for downside correction. So I was going to trade that setup through options, and when you trade options on ETF or on futures, you always have 3 questions to answer. First, you have to pick the correct expiration day. Looking back at the chart, when we are looking for the answer on that question, so first question for us is that how long it took that rally which we are going to fade, and basically that rally was pretty fast and it didn't take long. So basically the whole rally last 2 days. That basically meant that the pullback might take less than 1 day, 1 day or couple of days. And because it was Thursday, what could happen is that we could not probably top on Thursday and Friday, and we could just drop on Monday. So that's why I was looking not only for expiration the next day on Friday, but also the next Friday on April 13th. So this is why I picked 2 expirations, April 6th the next day and April 13th the next Friday. The second question we had to answer, we had to pick strikes of options. And to answer that question, we should again come back to the chart and look at the chart. If I traded options on Russell, the chart would give me the answer. So what I would probably pick is that I would look at 2 last pivots. You see, this is the latest pivot where the price found support, and that's another pivot lower than that, and that's another one. So probably I would pick that target around 1535, and I would pick that target about 1530. That would be my strikes if I traded options on Russell. But because I traded options on IWM, the ETF on Russell, we have to switch to IWM chart. And the same principle, this is the time where I posted that setup, and at that time we had to come back and check 2 previous pivots. That was one of them, and that was another one. So as you can see, 152.50, another one 152. I'm picking those 2 previous pivots as the most reliable and most reasonable targets, immediate targets for the pullback. And as you can see, basically, even when we dropped on Friday on those news, we stopped at that specific level because it was clear that the price would be unable to clear up both of those pivots from the beginning. This is those two pivots, and this is the answer for the second question. Our strikes are 152 and 152.50. So based on those answers for the first two questions, we got our targeted options. IWM with expiration on April 6th and expiration on April 13th with strikes 152 and 152.50. Okay, so we've got answers for the two questions, and now we have the third question, which is the trickiest question. How much we are prepared to pay for those options at that specific moment. So let's come back and zoom in that pattern. So we are at that point, we have identified our targeted options, and the question is how much we are prepared to pay. So at that moment we understand that, so basically we are at 1538 and we have our first target at 1544, so it's just 6 points away, and our red box says that basically this price can stretch to 1548, and that would be 10 points from here. So the question is, what would be expected decline in option prices? Because it doesn't make sense to buy options right here if we expect that price would continue climbing up. And so let's talk about that very important and interesting question. So how we can foresee what would be the price of our put options at the time when price finally finds its resistance somewhere close or inside the red box. So let's look at one of those four options we identified. This one was the option with the strike 152, which to be expired the next day. So remember, so we are talking about Thursday morning, and that option would expire on Friday. And at the time of the post, about 10:28 a.m., the price was 52 cents. Okay, so looking at that, we should understand basically who would be on another side of our trade. And let's talk about that. It's very important. So we should understand who is the seller of the options. Those are option dealers. And every time we buy stock or option, we think that we understand better what's gonna happen, and the person on another side of the trade think he knows better and he gonna win and you gonna lose. When you buy options from ask price, so for example, let's imagine that I posted the chart and you thought, okay, what if it doesn't make one more high? I will rather buy it here because your chart said that it will retrace lower than the current price. So let's imagine that you buy from that ask price. So you essentially buy the option from an option dealer. An option dealer sell options at prices calculated by powerful computer algos, which would take into account the risk of the potential drop. Because what option dealers essentially do, they sell risk. They charge you for taking risk of decline if they sell you put. When the price is steady climbing up or falling down, as if it was happening at the time when I posted my chart, basically option dealers may keep bid and ask price calculated by the algos. At that stage, those options are reasonably well priced. It means the price of the option incorporates the risk of decline. So basically when you buy it at full price. Remember, imagine you want to buy a new TV and you go to Google and you just Google Samsung new 55 inches TV and you get the price, let's say in $1,000. So maybe that price looks reasonable to you. But many of you, the majority of you, would say no. I would wait until Black Friday or some special sale for 4th of July, and only then I will enjoy special discounts. So at that specific example, you are not prepared to pay the regular price. What do you pay the regular price for options then? Why you think that you can win the trade when you have an algo on another side of the trade which has made complex calculations to set the price? And the majority of us, 99.9%, are very bad at calculating the price of assets. And we are basically, because of that, we normally overpay for that. And the only way for us to win in that trade is to wait until the price for options gets miscalculated, gets mispriced. And that normally happens when price for underlying assets approaches its top or bottom. And when it happens, normally it happens with a spike in price, when price starts enters some acceleration mode. So this is what actually happened. So I posted that chart at 10:28 a.m. and the price for the option was 52 cents. And at 11:56 it declined to 26 cents. So basically, for less than 1 hour and a half, it lost 50% of the value. Why it lost that much? Because we are talking about the option which would expire the next day. And the higher was the price of the underlying asset, the less risk option dealers actually attached to the probability that the price for the underlying asset will decline. And as you may remember, we were talking that in order to bottom, the underlying asset had to make only 10 points higher. But look at, and basically it was less than 1% of the price of the underlying asset. But look what happened to option. It fell by 50%. And that means that if you bought right here, when I posted the chart, you would lose 50% of your investment until noon. And what basically does it mean is that you should not be in a hurry to buy options from the ask price. You had to bid for weekly options with the price which would be less by 40% from the price which you saw, which was initially offered by dealers at the time I posted the chart. And you had to do it in tranches. So I would suggest that you had to buy it at least in 2 equal tranches, or maybe the first one smaller tranche and the bigger the second tranche, and basically you would keep them at different prices. Okay, let's look at another example. The same timing, but now we are talking about another option. That was the option which to be expired the next Friday, April 13th, with the same strike 152. So at the time of the post, the price was $1.45. And you see that same strike, but because the expiration date was 1 week away, option dealers actually valued that option much higher. Basically, it was the triple the price of the weekly option, because the probability of the decline within a week was much higher than within the last 24 hours of the weekly option. And here was the same question. You could have bought it right away, right at the spot from the ask provided by option dealer when I posted the chart, not waiting until it tops, or you could wait. Let's see what happened the next 90 minutes. Boom, it dropped as well, and it dropped to 104. So essentially it lost 40% in 1 hour and a half. And you see the difference. The shorter the duration of the option, the more volatile is that. So basically, if I showed you here another option with the same strike 152 but expiration of April 20th, I would say that it normally lost here around 30% of the price, maybe 25% of the price. So you should always adjust to the duration of the option you try to trade. So basically in that particular case, if I posted my chart and you wanted to take advantage of the chart, you had to input your bid price into the system, which would be 30% less from the price initially offered by option dealers at the time. And you should always do it in tranches. So the second tranche probably would be less by 40% from the price you saw it at the time of my post. So this is what happened next, and this is my next post that day, posted at 11:53 a.m. and this is exactly where price topped. It entered the red box and that was it. And look at the time, remember the time, 11:53, because I personally inputted into the system my bids a little bit earlier than that. So once probably we hit the lower band of the box and I saw that congestion, that was a bad sign for bulls, that was a sign that, you know, the rally is running out of steam. So let's talk about the reasons why price for options jumps that much in a matter of minutes. So remember, price for their underlying asset went up only by 10 points, while the price for options dropped by 50%. We were talking about completion of wave 3, impulsive wave 3, and normally any wave in an impulsive 5-wave structure gets completed with some climatic moves. In majority of cases, those final bursts of prices are driven by retail investors. So we keep waiting, we keep holding the shorts on the way up, and we keep bleeding until the very last moment when we see the very last burst making new high, and this is where they put their stops, or we just can't stand it anymore. So they just want to get out, we want just to stop that bleeding, and we do not care about the price anymore. This is the most important part. And those climatic moves get exaggerated in options. Those accelerated final moves make dealers widen the spreads between bid and asks. And those crazy retailers who were short, they cover the underlying assets, and we also sell the options we had. So once that accelerated moves happen, dealers just are unable to keep the narrow spread, and this is where retail investors go nuts, and they just sell those puts at any price we have at the moment, especially if they were stupid enough to set stops for those volatile options. They sell orders get executed at the price which is available in the market, and those are your bids. This is when your stinky bids immediately make you 20% on your investment. People call it stinky because then at the time you input it into the system, they look completely unreasonable. Nobody could imagine just 90 minutes ago that the price would drop 50% in a heartbeat. And this is why people call them stinky, because, you know, this is just unreasonable, it doesn't make sense. And this is your premium. This is basically where you capitalize on emotions of other retail investors. This is how you earn your almost instant premium. You just set your bids, and at the time of fast change in the market, market makers fail to adjust the pricing fast while your bids are in the system, and your bids are likely the bids which will be filled by those crazy guys who want to get out of those puts at any price just because we are losing money. So let's look at my actual trades that day. As you can see, I started just to put my bids into the system at 11:17, so basically 30 minutes before the price reaches the top. And as you can see, I just inputted like a whole bunch of different orders for different expirations, but all of them like 152, 151.5, and those 2 weeks. The next day, April 6th, and another week, April 13th. And as you can see, not all of them got filled. The yellow ones did not get filled because we were pretty aggressive, we were too stinky. Price did not reach those prices I just put. But I got filled on 2 orders, and once I just inputted those orders into the system, I just left. I just went to a local coffee shop. I just had chat with my friend, and I enjoyed coffee, fresh croissant. At the time I came back home, and I checked my trading terminal. I saw that I got filled, and I sold them immediately, booking some profit. A little bit later on, at 1:32, when prices got back up, I decided to reload the puts I had bought and sold earlier, as you can see. So I inputted new orders around 1:38, and again I decided just to go along the same 2 options I got filled before, with expiration the next day with strikes 152 and 152.50. But that time I was not prepared to pay the same price. As you can see, my initial fill, for example, for that 152 option was 28 cents, and my initial fill for 152.5 strike was 38 cents, and I put it at 29. Why? First of all, because since my first bids got filled at 11:33, basically 2 hours passed, and we are talking about options which would be expired the following day. So basically, the less time they have before expiration, the less risk option dealers have to price in. The second reason is that essentially option dealers saw that the price dipped down and immediately got bought back. So for them it was an indication that the market is pretty strong, and I understood that basically that should affect the pricing of the option. So they should charge less for the same options just 2 hours after the initial fill. And as you can see, I got filled on one of those orders, and I was managed to sell it later at 31 cents. And the only reason why I sold it, because based on my chart, I expected a gap up on Friday, and you know what happened next. We basically got a gap down on news, but my plan was just to add to buy back those options at Friday open. It didn't happen, but basically I booked nice profit on the trade. And the very important caveat for that technique, so you should not care about all your orders to be filled. You got filled on 2 of them, that's okay, and I'm showing you only IWM trades. I did the same with QQQ, and I got filled several orders on QQQ as well. So basically doing that, you can make several $1,000s a day, if the count is correct. So what I want you to take away from this video: every time you think options are sold at reasonable attractive price, you are most likely wrong. The other guys on another side of the trade might use powerful algos. We took into calculation all the risks. You should never pay the price option dealers want you to pay. Step back and start to negotiate. Offer them your own price, minus 25% or even 50% for weekly options for the price you're emotionally prepared to pay. As you have seen on that example, you can get a drop by 50% in a matter of minutes in that market, especially if we are talking about weekly prices. Ask yourself, so how many times you tried to time the very top or bottom in the market? And how many times of those tries you actually saw that price kept going higher or lower? If you ask myself, I would tell you it normally happens 95% of the time. So why you would take advantage of that? Never buy in one tranche. Again, we are very bad at anticipating the top and bottom. And if we think that this is the top of the bottom, the risk is the price will continue going higher. So why would you adjust your order, understanding in anticipation of that case? Be prepared to get filled on your stinky bet and enter another bid for the second tranche and lower price, discounted by another 20-25%. What I mean is that when you enter the order for the first tranche, do the same for the second tranche at the same time. Why? Because that last segment of accelerated growth or decline would be so scary that it would affect your thinking as well. You are not special. Why those people do stupid things when they sell at bid at those climatic moves? Because emotions prevail. And emotions prevail in your case as well. So many times I saw myself actually get scared. I could expect some move, final move, emotional move, and when it happens, I started to doubt my count. And in those cases, my bids were still in the system. I could actually enter my first bids and bids for the second tranche and leave them in the system for the next day. So the next day we might get an explosive move up, a gap and crap scenario. So it gaps up and falls down hard. But if you didn't input your order the day before, you would not be brave enough to do it at such an open, believe me. So you would join the crowd and you would be scared, you would be paralyzed, you would not be able to do anything. You would be just watching, and then later you would be amazed why you didn't follow your plan. Because you got emotionally affected as anybody else in the market. My fourth advice is, once you actually input into the system those orders, leave the bait, your stinky bits, and go somewhere. Just don't stare at those orders, because again you will start doubt it. You will think, what if you need to change that price? And I've been there. I did that, and every time I change the price, I calculate it like that. I regretted about that later, because that was the price where options topped or bottomed, but because I doubted that, I let my emotions prevail. I changed that. I thought, okay, I would adjust the price by another 10%. And that was a stupid mistake, and that is why I missed the train and I did not participate in the following move, which I fully anticipated, but I missed the point because I let my emotions do that. So input your bids into the system with the price calculated like that, and let others people panic in your favor when you're enjoying your life. You can watch Netflix, you can play with your kids, you can go to a local shop or a supermarket. I do it like every day, guys, and it really works for me. Thank you for your attention. I hope that my advice will be helpful to you. Please visit from time to time my website castawaytrader.com, follow me on Twitter, and if you have any questions, please shoot me email. My email is pretty simple, castawaytrader@gmail.com. Good luck with your trading.